What's better than earning money from a 9-to-5 job? It's earning money while you sleep, which is made possible if you start investing. You're listening to the Real Estate Investing Demystified with your very own dynamic duo, Ava Benesocky and August Biniaz. Tune in as we discuss everything real estate, both on the passive and active sides. We feature life-changing stories of today's real estate leaders that will help build your own roadmap to success. This is a show that will lead you to a diversified portfolio, a much bigger revenue, and a next-level venture that brings you a smooth cash flow. Let's get this episode started.
All right,
Let's get this episode started.
Back at it again after a little mini vacation. The whole time all we were thinking about was work.
Yes.
But excited to be back. We have our guest and friend and associate, Josh Cantwell, on the show. We were on Josh's show, and
it was a really fun time being on Josh's show. You know, there's quite a bit of people who reached out.
Yes.
Said, hey, I heard you on Josh Cantwell. So we hope to do the same for Josh today. He's on our show, guys. You're going to get to know the man.
Yes.
He's just
and
incredible.
He's had some tremendous guests, Donald Trump Jr., and with what's happening with Trump, I bet that he's probably furious of having FBI agents running through his dad's house.
I bet, yeah.
But we won't get into the
absolutely.
politics side of things. So let's start the show. Maybe you can tell our viewers and listeners a little bit about Josh.
They've got to know about the man himself. So Josh is a true entrepreneur and prides himself on never having had a boss in his entire life. That's awesome. Josh has vast knowledge and experience in helping to coach clients and mentor students and borrowers from across the U.S. in finding, structuring, negotiating, and closing various types of transactions for profit. Now, Josh is also the host of the Accelerated Investor podcast, which has hosted August and I, and guests like Kevin O'Leary, Barbara Corcoran, Donald Trump Jr., Jack Canfield, Rod Cleve, and J.V. Crum III. He is also the founder of a variety of successful businesses, including Freeland Ventures, Strategic Real Estate Coach, Accelerated Investor Office, and more. So we're really excited to dive into this entrepreneurial's mind. Josh, welcome to the show.
Welcome to the show, man.
Having me. Wow, that's a crazy bio. I surprised that's me. No, I appreciate you having me on the show, and man, I'm excited to share. I love talking to an audience, and especially new folks, to have a positive impact on their future through this. So thanks for having me on.
Yeah, we're really excited to chat with you and get things going here. So if you can just start off by telling us about your background and then your start in real estate.
Well, today, I've done 18 major apartment syndications. We own 4,300 units of apartments. We actually sold off 1,300 units last year, so we're sitting at 3,000. We invest in what we call cash flow stable markets, which means the Midwest, the South, and the Southeast. We stay away from what I call boom bust markets, which is primarily along the coastlines, Florida, New York, New Jersey, California, things like that. And I've had kind of three phases of my life, really, even four. So real quick, I started out when I graduated from college as a financial advisor. Now that's important because I use a lot of the same strategies today to raise money that I learned 25 years ago when I was a financial planner. I graduated from college, got my Series 6, 66, 63 life and health license. Most of my clients were 2, 3, 4 times my age. But I got very comfortable talking to people about money. But I also realized when I was a financial planner that most of my successful clients owned real estate and did not have all their money in the stock market. So I took notice. I started going to weekend boot camps, and then I fell out of love with financial planning, and I fell in love with real estate. Even though I was 25 years old, 26 years old, making $200,000 a year, I didn't care for it anymore. So that wrapped up phase one of my life and moved into phase two. So I started in real estate like a lot of people: Rich Dad, Poor Dad, multiple streams of income, Robert Allen. I fell in love with the concept, but I didn't have a lot of my own money. So what did I do? Like a lot of people, I wholesaled properties, I fixed and flipped, I did transactional stuff. And that was from really 2004 all the way until I got sick in 2011. We started doing pre-foreclosures and short sales before the crisis. I grew up in Cleveland. Cleveland had 10 major Fortune 500 companies leave town all at the same time, roughly within like a 5-year period. And there were it was way more inventory than there was houses. So we started looking at how we were going to get invested in real estate with no money down. And we fell in love with pre-foreclosures and short sales. We became one of the nation's leading experts. We started flipping over 100 to 150 houses a year. Then when the foreclosure crisis hit, we were 3 years ahead of the curve. We were already teaching it. We did massive events in Vegas and Dallas and everywhere. Then I got sick. In 2011, I was diagnosed with pancreatic cancer, advanced pancreatic cancer. My wife we had two small kids, and my wife was 8 months pregnant with our third. And I was diagnosed with pancreatic cancer that has just a 7% survival rate. And not only did I realize I was in jeopardy of leaving my wife as a widow, but I also realized that my business was structured totally wrong because I was so transactional. I didn't have a way to make money. Like, the business made a lot of money when I was there, and the team was working. We were working together, but every deal was a paycheck. Do a deal, make a paycheck. Do a deal, make a paycheck. And now I was forcibly removed from my business for 9 months, 3 or 4 months before the surgery, and another 5 months after the surgery. I could not work. And so what happened, though, right before, and August mentioned this at the beginning, was right before my surgery, I bought a couple properties with private money, and I was able to have a JV partner kind of manage the properties while I was sick. We ended up selling the properties that I never saw. I saw them 2 times, and we made about $150,000 on these couple properties. And I realized I was able to control the flow of money and control the deal by controlling the private money and the capital. And I was like, okay, if I did that from my deathbed, essentially, I could probably repeat this if I could actually work. And so then I fell in love with private money, which started kind of phase 3 of my life, where I did a lot of fix and flips. I started buying lots of rentals. And then we recruited so much capital that we started our first private equity fund in 2014. And the way for us to create private money or create passive income was to lend money out. So we were doing private money lending and hard money lending out of the fund. So it was a very natural evolution. Where we had more capital than we needed. We threw the capital in a fund. We started lending it out. Investors got great returns. Now this begins phase number 4 of my life, which is the phase I'm in today, where my investors started saying to me, Josh, this fund is great, but what else do you got? What else do you have? And I had some friends that were in multifamily. We were underwriting some of their deals. We were funding some of them through our fund. And now we saw an opportunity to joint venture with them, sponsor loans, and bring in equity because these guys wanted to scale their business, and they needed more equity. They needed a bigger balance sheet. We had both of those. We had a big balance sheet, and we had the ability to raise a lot of capital. And then so over the last 6 or 7 years, we've migrated 100% of our business into multifamily. We now own all these units. We've raised tons of money. We've wound the fund down. And finally, I'm actually living the life that I read in Rich Dad Poor Dad 15 years ago. I'm a 15-year overnight success. With all the mistakes I've made and surviving major health problems, I'm finally exactly where I wish I had started 15 years ago. So that's my first piece of advice for the audience is what you learned in Rich Dad Poor Dad about cash flow and apartments and equity and self-storage. Don't feel like you have to flip houses or do residential first. Just get into commercial apartments right away, because I wish I had done that.
Tremendous story, man. Wow.
Yeah.
There's a lot to break down there, but imagine that. Imagine having that, surviving something that has such a low rate of survival. I mean, you hear about pancreatic cancer with people like Steve Jobs, a few other very famous people that...
Luciano Pavarotti, Patrick Swayze. Yeah.
Yes, like so many famous people that get it because the diagnosis is so late by the time it gets diagnosed, because the symptoms are just not there, that the survival rate is really low. So they talk about lucky and having somebody, their nickname to be Lucky. So I guess we're gonna call Josh Lucky in house here. So yeah, break it.
Sharing that, Josh.
Absolutely, man. Just to break it down a little bit more about your journey. So the life-altering situation kind of was the impetus for you to focus more about being somewhat of a hands-off investor, being involved, but raising private capital. Now you're raising private capital. You also or you guys raised a fund to do private lending. We call those types of funds here in Canada mortgage investment corporations or mix. But in the US, you create a fund, so you're lending money out, but your investors are also looking for different types of investments. Now,
Correct.
prior to that juncture, you had not syndicated any commercial real estate larger projects utilizing the private equity model, GPLP model, till that moment.
That's correct.
Yeah. Okay. Great.
That's correct.
So then now they're coming to you, and you have any other deals? You're connecting with other operators who have deals who are in need of equity. You're like, hey, we got access to equity. We can come on and partner with you and bring you to equity. Or now, are you coming on as a co-GP raising capital? Are you coming on as pref equity on the capital stack? How did you structure it, trying to partner with these operators?
Co-GP. So we got involved in underwriting. We got involved in sponsoring the loan as well, and raising capital, and also sourcing contractors and insurance. So we weren't just like raise money, give us equity. These were 2 or 3 guys that I had already known in real estate for several years. A couple of them actually lived in my neighborhood. But they had already made the pivot from Resi to commercial. They already owned a 50 unit, a 100 unit, a 200 unit. And they were like, okay, this is working. They were just maybe a year or 2 years ahead of me. And so it was a really natural joint venture. I know a lot of guys out there are like, we can raise a lot of capital. We'll be a co-GP. This was more of an organic, natural relationship that I already had with these guys. And so we did all of that, but it was co-GP, raise capital, sponsor the loan, underwrite the deal. And then we were on all the owner calls, and we handled a lot of the investor relationships, and continue to have those today.
That's awesome, Josh. What year was it? And you may have mentioned this, but what year is it when you got started in real estate?
So my first property I ever bought I was 24 years old. I bought a duplex, 2001. I went full-time into real estate in 2005. I got sick in 2011 and did my first apartment deal in 2016.
There you go.
Okay.
All right. Awesome.
All right.
Awesome. So now since that time, so is the business model for you and your group still partnering with operators in a co-GP structure? Is that the model you're utilizing currently?
No, actually, it's morphed now. So we started buying our own assets as well as our own GP operator sponsor. We started doing that as well. And then when COVID hit, we had both the JV deals, the co-GP deals, and we had deals that we were owner operating in the Ohio market. I'm from Ohio. I'm from Cleveland. And we love Ohio because there's a stable cash flow market, which is Cleveland. And then there's a booming market in Columbus and Cincinnati that are just really taking off, especially with the semiconductor plant and stuff like that. So we decided that we were also going to owner operate. So then we started doing our own acquisitions, doing our own underwriting, sponsoring our own loans, recruiting our own capital. And we were vertically integrated. We were doing our own construction and our own property management for a while. Then we got, frankly, too big, too fast, and we had to give one of those up. What we decided to do was we were going to hang our hat on the construction side of things. And we were going to give up the third-party property management to professional third party. We were going to manage them like a hawk, which we still do. They probably hate us for it, but we manage them like a hawk. And we're on top of them all the time. But we, in the industrial Midwest, there's not a lot of new construction, as you guys are aware. If you build something, it's going to be class A, it's going to be fairly luxury, it's going to be in the urban core. There's just not a lot of construction in the suburbs. So we buy firmly B class and C plus and B minus assets that we can manage to at least a B or a B plus in the suburbs. And we do what I could think is what I call heavy value add. So when we buy them, we're doing full turns and we're putting in $5,000 to $10,000 a unit. And most of that money is going into the unit itself. So it's a full gut of the kitchen, the bathroom, new flooring, stainless steel appliances, and everything. So we hung our head on construction, guys, because we knew if we did a really good job of renovating the unit, it would lease itself and we would get a massive bump in the rent. So we're forcing the appreciation. We're not really waiting for the market. We're looking for that thing that's got distress. It hasn't been updated. We're buying this 1970s, 1980s vintage properties, and we're really focusing and hanging our head on construction to force the value. I still have some co-GP JV deals in my portfolio, but everything that we're buying going forward is all for our own account, and that we're the sponsor of.
Amazing, amazing. Last question on this topic, kind of breaking down again your journey. So you start raising more capital, you're partnering with sponsors, you're doing deals, but then at some juncture you make the transition into doing your own deals. To be able to do your own deals, you need to have your own acquisition team. How did you go about growing your internal company to bring on possibly an acquisition director, or for yourself to get more involved on the acquisition side of things, asset management? How did you grow your company internally to be able to then do asset management and acquisitions?
Great question.
Great question. I'm a firm believer in partnerships. Every major business that I've built, and I've built many of them, has had a partner, at least two people. Normally, you got one person that I call out of the house and one person that runs the back of the house. So when you look at real estate, especially multifamily acquisitions, you typically have somebody in one swim lane. That swim lane is marketing, it's branding, it's underwriting and reviewing deals, and it's raising capital. It's really the front end of the business, right? It's the marketing, it's investor recruiting, branding, working with brokers, and when deals come in, underwriting those deals and then raising capital. That's my swim lane. Then my business partner, Glenn, who was my business partner in the fund, Glenn is much more familiar with and an expert at construction, CapEx. So Glenn runs our CapEx swim lane, and we hired a VP of construction that had 35 years of commercial construction experience. So once we were at scale and had enough of a CapEx budget, we knew we could afford a guy. His name is Dave. We could bring a guy in like Dave, who had built residential assisted living from scratch. He had built apartment buildings. He had done office conversions. He had this long track record of experience. To answer your question, though, about acquisitions, we brought in a third partner, Tyler. Tyler was actually our director of business development in our fund, but he was an employee. We loved his work ethic. He's hustler, a little bit younger, a little bit different dynamic. He was used to the mortgage origination business. We thought he would be great in acquisitions because he just is hustle, rock and roll, work long hours, that type of stuff. But Tyler also owned 150 units of single family. So it wasn't like this was new to him. So he was used to property management, asset management of his own portfolio. And now the good news is we had the fund, we had credibility. We had these JV deals, we had credibility. So when we went to talk to local brokers, they had there was not even a second guess of whether we could close or whether we were a credible buyer. So Tyler just turned on the spigot, if you will, of going to look for acquisitions, talking to brokers, talking to wholesalers, making relationships with what we call the big seven commercial brokerages, including Marcus & Millichap, Colliers, Cushman, all those guys. He went to all those guys, made relationships. And because they saw what we had done in the past with the fund and with the JV deals, they started feeding us deal flow right away. So we decided to split that up. So when we split up the JV LP split, me, Glenn, and Tyler, I'm the CEO, the majority shareholder. They have minority equity, but the three of us buy all of our deals together now. And it allows us each to have a different swim lane that we can focus on. Tyler's is acquisition, asset management. Glenn's is construction primarily and finance. And mine is upfront marketing, underwriting, looking at deals. I've kind of put my final blessing on every deal we buy. That has to be my final decision. And recruiting and raising all the capitals on me. So that's worked out really well. And we've been able to scale just in the Cleveland area from 0 units to 1,400 over the last about 4 or 5 years.
Wow.
It's all about the team. It's
Absolutely.
all about the team and staying in your own swim lane and making it happen. That's really cool.
All right, perfect. In respect of our time, let's switch the focus to raising capital, and let's talk about your super system of seven steps to raising private capital. Maybe you can go over that with us.
Yeah, I'm excited to hear about this, Josh, because that's what I do here.
That's Ava's swim lane.
That's my swim lane. So let's hear the goal.
Yeah, for sure. So we've raised tons of money. I've raised and deployed almost $100 million, and all of that, to be clear, none of it's family office, none of it's private equity, none of it's institutional. It's all true mom and pop private investors, mostly accredited, some non-accredited, but it's all 506B, 506C. So we've raised a ton of money. We're really good at it. I think, first of all, you have to be willing to put yourself out there. So step number one is you have to be willing to be out in the marketplace at everything you can do that's a face-to-face networking opportunity. Seminars, Facebook groups, meetups, live events. Number one, if you're going to raise a lot of capital, you got to go talk to a lot of people belly to belly. Okay. You got to be willing to talk to friends and family. That has to be part of it. Because if your friends and family aren't willing to invest with you, you're probably not going to convince a private investor that's got $10 million to invest with you, or even $100,000. So step number one is what I call the face-to-face, belly-to-belly networking. All of us do it. It's kind of the pillar, the cornerstone of what we do. That's step number one. Being out at least one event per month, and preferably not at the event as an attendee, but at the event as the featured speaker. Okay? There's just something different about being the guy in the front of the room than being the guy or the gal that's in the audience. You're going to recruit a lot more capital if you can get the speaking engagement. So step number one is go to the events, but get the speaking gig. Get in front of the room, not a part of the audience. Step number two, right? So we create what we call a multi-medium marketing machine. And so step number two is we're a content creation machine. We do podcasts like this. I'm on probably 3 to 4 or 5 podcasts a week. I host my own podcast, but that podcast is edited and produced by a professional podcasting firm that creates the YouTube videos, blogs, blog posts, Facebook group posts, LinkedIn posts. They do it all for us. All I have to do is get on the podcast and talk. And I have to have a compelling message. Everything else that happens, from production to social media posts, email marketing, all of that gets done by a professional content production team. It costs about $500 an episode. That's what it costs us. So about $3 to $4 grand. If we produce 2 podcasts a week, it's about $3 to $4 grand a month to have that machine just done for us. I use a company called Podpost Media, if anybody wants that introduction. So I'll let you even know who does it. So all of the face-to-face group stuff, preferably in the front of the room. Step number 2, the content production. This is what I call the one-to-many concept. This is one of the traits. I have a whole talk I do around the traits of elite entrepreneurs. Not just elite real estate investors, but elite entrepreneurs in any niche scale what's called the one-to-many concept. When they open their mouth and talk, they're going to talk to more than one person. They're going to one-to-many. So whether it's a webinar, whether it's a radio show, whether it's a podcast, whether it's email marketing, social media posts, all of that is one person, me, going out to many people. So I'm casting a super wide net. So step number 1 and step number 2 is all about that one-to-many. I want to get in front of the biggest groups I can and cast the widest net I can. Okay. Now, with that being said, step number 3, we've got to have a place where these people can opt in and can engage with us while we're sleeping. Okay. So step number 3, we've got to have an opt-in page or an opt-in mechanism, a website or a investor portal or some way to collect opt-ins regardless of where you're at. You're walking on the beach, you're going out for dinner with your spouse, whatever you're doing, it's available all the time. Okay, so a lot of people use different softwares. It could be AppFolio, it could be Syndication Pro, it could be a website. You've got to have a way for these people to opt in. Now, one of the things that I learned long ago from a guy named Joe Polish is that marketing is sales in print. Okay. So me and my team have written a 120-day autoresponder where we send out 2 to 3 emails a week for 120 days. And all of that content, this is step number 4. So when somebody opts in, the autoresponder happens. And what we're doing is we're selling ourselves through an automated marketing approach. That automated marketing, I'm not pitching a deal. I'm not selling them a security. I'm not selling them a PPM. I'm educating them, again, while I sleep through our email autoresponders. So they're getting more episodes of our podcast. They're getting more episodes of our YouTube channel.
We call it our nurture process here. That's
Right.
what you're, yeah.
Right.
That's right. So we nurtured people through that. And in every single email, okay, this is kind of where the secret sauce comes in. There's a link for them to book a one-on-one call. You guys probably do something similar. Now, here's the difference. A lot of people want to raise a lot of money, but they want to have, a capital guy do it, or they want to have an assistant do it, or they want to do it. This is where I take the one-to-many concept and reverse it. Now I'm going to do a one-to-one. Okay, one-to-one. And this one-to-one, so we have the opt-in step 3, we have the nurture campaign step number 4. Step number 5, I'm going to move the person that's in our autoresponder. I'm going to let them automatically book on my Calendly link. Step number 5. When they book, it automatically creates a Zoom and I get on the Zoom. Now, here's the difference. When I get on the Zoom, the first thing I say, okay, is, hey, thanks for jumping in. I appreciate you, engaging in our content. How did you learn about us? Things like this. And then I use the SEC, the Securities and Exchange Commission in the United States. I know you guys are up in Vancouver, but in the United States, the SEC, I use it to my advantage because the SEC says that I have to have a prior existing relationship with these investors before they invest. Okay. Even if it's 506C, I don't have to have that existing relationship. I want the existing relationship first. What I found after raising money, millions and millions and millions of dollars, is that investors don't want to be sold. They don't want to be pitched. They want to make the decision on their own. They want to make the decision logically that they feel like they made the decision to invest, not that they were pitched or sold. So first thing I say when we get on the phone, we have, back and forth dialogue for a few minutes, but then I'm going to say something like this. I'm going to say, listen, I appreciate you and all your interest in what we do. However, the SEC requires that in order for you to invest with us or even consider investing, we have to have a prior existing relationship. When I was a financial advisor in my early 20s, I would do a fact-finding appointment. I would get to know a possible prospect and everything that was important to them. Their risk tolerance, their time horizon, what they had invested in the past, what are they going to do with the money, all these kind of things. So if it's okay with you, not only is it required by the SEC, but if it's okay with you, I'd like to learn more about you and make sure that you're a fit for what we do and make sure we're a fit for you. Okay. So we don't talk at all about returns. We don't talk at all about me. We talk very little about my investments. I'll say really quickly, yep, I've done 18 syndications. I bought 4,000 units. We've raised $100 million. Now I make the conversation 100% about them. Okay. So I'm starting to ask them questions like, are you married? Do you have an accountant? Do you have an attorney? What have you invested in the past? Have you done stocks, bonds, crypto, real estate, all these different kind of things? Okay. And then I say, well, great. Look, we're on this path now to create this prior existing relationship. And what I want to do next is I want to book another call with you, a Zoom call to learn more about you. And then I can show you one of our past deals. Because if you understand our past deals, the next deal is going to look very similar. Okay. So now we're done with step number 5, which is this introductory call, but I do very little talking. Okay. Remember this, guys, all of our audience, he who asks the questions is in control. Okay. He who asks the questions is in control. So August, Ava, have you ever gotten on a phone with an investor and the investor's just peppering you with questions about your deals and about yourself, and you feel like you're on your heels, like you're on the defensive, right? Why? Because the person that's asking the question is in control and the people that's getting peppered with questions is not in control. So I've realized that if I want to be in control, I need to make it all about them, and I need to be really good at asking questions. So have you invested in stocks before? Great. How long? Great. Have you invested in crypto? How'd that go for you? Have you invested in real estate syndications? Great. What do you like about those investments? What do you don't like about those investments? Who helps you make investments? What are you going to invest for? Is it geographic? What, diversification, blah, blah, blah. So I've got a little script I use with all these questions just to remind myself about what to ask. But by the time that's done, right? Remember, people also love to talk about themselves, right? So by the time we're done with that conversation, which I always have a hard stop in 30 minutes, by the way, I never let that first call go more than 30 minutes. Matter of fact, I prefer to keep it to 20. And I prefer to tell those people, hey, I have a hard stop. because I want them to know I'm busy and I don't have just time to get peppered with questions.
I just got to tell everybody that Josh is dropping some real gold here. So take your notebooks out and write this down if you ever want to raise any money. So just letting everybody know. Just keep going, Josh.
Yeah, sorry for the sake of time. We're rolling, right? So then I go into step number 2. So again, we book another Zoom call. My assistant sends out the link and the calendar invite. They come onto the second call. And again, for about the first 10 or 15 minutes, I'm just reminding them now of everything I learned about them because I'm taking copious notes. I'm putting it into my investor management portal. This is step number 6. I have this now, all these notes. When we get on the phone, I'm going to kind of spit back to them everything I learned about them in the first meeting, because now they're going to realize I paid attention. Okay. The other part of this, I'll give you another quickie. In the first call, I do not turn on my webcam. Oh, if it's Zoom. No, never turn on my webcam. Second meeting, always turn on your webcam.
Really?
Okay? Yes. First meeting, listen, and this comes from my experience being single. When I was dating, I hated going to dinner with chicks because I didn't even know if I liked them yet. So why would I go to dinner, bury myself in an hour and a half conversation, buy them wine, rack up a big bill, and then think, God, what a waste of time. So instead, right, I would rather get to know them a little bit, a little bite-sized meeting, see if I like them, if it's worth it, to then go to step number 2. Same thing with raising capital. I didn't want to waste and spend a bunch of time in the first meeting and make myself super available when I didn't even know if I wanted them as an investor yet. Okay. So now second meeting, I turn on the webcam. Now it's like, hey, now we can see each other. I'm asking questions, and I'm also then going to do a little screen share of a previous deal or a hypothetical deal, not a current deal that I'm working on because we don't have the existing relationship yet, but I'm going to show them what we've done in the past, preferred return, equity, however that deal was structured. And then I'm going to always say in the second meeting, listen, it's great to meet you. I appreciate it. Sounds like if I found a deal like this, is this something that you'd be interested in learning more about? Not if I found a deal like this, is this something you'd be interested in investing in? It's always just, are you interested in learning more about it? Okay. They say, yeah, I definitely would be interested in learning more about it. I said, okay, great. Then I almost always wrap up with this one line, which says, hey, listen, I appreciate, it sounds like we might be a fit for each other. Sounds like you really enjoy what we're doing. Sounds like you're a great person. I've learned a lot about you. Just so you know, if you have a lot of investors, which we do, this works really well. I've got over 300 investors. We've raised 80 or $100 million. Fill in the blank with whatever you've raised, however many investors you have. And then you say something like this, I don't really need any more money for my investments, but you sound like a great person. So if we found a deal, I could probably find a way to use your money. I don't need it, but I could probably find a way to use it. Okay. So now again, I've taken all the control out of their hands because now they know that I care about them. I have the relationship. I've built a relationship. I've asked them tons of questions about themselves. I've showed them a sample deal that they can earn a 20 to 25% annualized return, maybe an 8 to 10% cash on cash or 12% cash on cash, an 18% IRR, a big return, way better than the market. And now I'm going to pull it all away from them by saying, I could use your money, but I don't need it. And I'm still in control. And now we're going to move to step number 3, which is the final step, step number 7. I'm going to have the final call with them. Again, I usually book these out 2-3 weeks apart, just whenever. And then finally get to the point where I say to them in the third call, now I've got the relationship. I'm comfortable. If the SEC walked into my door, I could check the box that says I have this existing relationship. I'm going to show them that same hypothetical deal, the past deal again. And now I'm going to say, look, I've got a deal coming. I've got this, 100 unit, 200 unit. I'm about to start raising for it. But I'm pretty confident. Let's say we're going to raise $5 million. I'm pretty confident if I go to raise for it, I'm going to easily raise $8 to $10 million. So I need to know if you're highly interested in highly liquid. Okay. This is the last and final step, because now they're making the commitment to that deal when they haven't even seen the pitch yet. Okay. So psychologically, I've won the battle. Okay. Psychologically, they're committed because they've seen the past deals. We have a relationship. I care about them, but I also took it away from them. I use scarcity as one of the best sales tools there is. I pull it away from them. And now I'm in a situation where they're dying to invest in your deal. Instead of me asking them for money, they're like jumping through the Zoom call to do it. Okay. So I win the psychological battle. And again, this all sounds like this is all sales skills I've learned over 25 years. This is real deals. I've done this hundreds of times. It only works 100% of the time. It works all the time.
Josh, a couple of questions I had for you. Just all around.
Yeah.
Second call, how long did you take to show them the hypothetical deal?
Again, I try to keep that less than a half hour.
Less than a half
I want
hour.
to honor my time.
Yeah.
I want to honor their time. And I always want to leave them asking for more.
And then the third call?
That might be more like an hour, because now we're down to showing them and really solidifying the relationship, showing them that it's a past deal. But now I'm thinking, okay, they're pretty close to being committed. So I don't want to rush them off. But the less time you have, the better, right? You don't want to make yourself super available. Everybody wants something they can't have. So make sure you honor your time. Keep most of these meetings to a half hour.
That's awesome.
Amazing.
And then the last thing, how often do you touch base with those investors after, or even after they've invested with you? Like, what's your personal touch with them where you get on a call with them?
Yeah, I mean, kind of whenever they would like to. We do a really robust quarterly update for all of our investments. We give them the P&L, we give them the balance sheet. We put together a PowerPoint document with multiple slides, pictures, everything that's going on with the deal. And then I voice record over it. I do a full Zoom call over it. So they feel like they have access to me. But again, it's the one to many where I can touch base with 20, 30 investors through that Zoom video call without having to answer questions from every single investor. But like, we're in the middle of getting close to a raise. We just got a deal under contract on Friday. We're going to go into that raise. I know it's going to close. And we've already got soft commitments for 7 million, and it's a small deal. I only need 2 million to close it. So using this approach that I've kind of walked you through today, we now have an overabundance of investors and we oversell almost every deal. So, but, they all know they can get a hold of Jen. Jen's my personal assistant, our director of operations. They all have Jen's number. So if any one of them has a question, they'll call Jen, just get on my calendar, Ava. So really, I want to make myself super available to them. They're the lifeblood of our business, right?
Yes. Okay, right on. Thank you for sharing that with
us. All right,
us.
amazing. Again, in respect of our time, you got to run. Let's do our last 10 questions really quick here if you got a few minutes.
Thank you so much. Yeah, for sure. We'll make time.
Okay, right on. I'm excited for this. 10 championship rounds to financial freedom. Josh, whatever comes top of mind, here's the first question. Who is the most influential person in your life?
My dad. He was my first entrepreneurial mentor. He owned his own business. He cut his teeth. He was a great mentor to learn from.
Amazing. All right. What's the number one book you'd recommend?
I love the book Who Not How by
Dan
Sullivan.
Yep.
And I'm listening to The 5 Love Languages of Teenagers because I have a teenager in the house. So I've got a lot to learn.
Oh, that's awesome. All right. If you had the opportunity to travel back in time, what advice would you give your younger self?
For sure, I would invest in commercial multifamily apartments from the beginning instead of doing residential and wholesaling.
Right on. Okay. What's the best investment you've ever made?
For sure, it's anytime you can invest in yourself. The weekend warrior boot camps, reading, podcasts, you're always going to get a higher return. Like if somebody said, Josh, it's my last $10,000 in the world. What can I do to get a return and make a living? I would tell them to spend all $10,000 on themselves and go to weekend warrior boot camps, training, maybe hire a mentor, because you're always going to get more scale, more leverage by making yourself better than just investing in an investment vehicle.
Yeah, best. Awesome. Okay, now what's the worst investment you've ever made and what lessons did you learn from it?
I can tell you that all the investments that I made that have been bad have been because I relied on a contractor, right, that didn't execute. So I made numerous bad investments in real estate, single family deals that didn't go well, or even multifamily deals that were behind schedule. It was always because of the contractor risk. That's why we started our own construction and do our own construction, because I don't trust anybody anymore. We do all of our own stuff. Right. But anything I lost money on, specifically in real estate, was because of contractors.
Okay. All right. How much would you need in the bank to retire today? What's your number?
Financially independent now. My wife and I kept, I think, a fairly low profile with expenses. I could pay all my bills and all that kind of stuff with, about 15 grand a month is really all we need. So, $1 million at 15, 18% return. Luckily, with all of our investments, we've kind of achieved that. So you got to buy assets that pay for your toys and your liabilities. It's what you learned in Rich Dad, Poor Dad. Like, remember Dolph DeRoos? Dolph DeRoos is one thing I remember. Dolph DeRoos would say when he wanted to buy a Porsche in one of his early books, he bought a small apartment building that had a garage. Like, he had that Australian accent. And I remember, like, what's a garage? Right? He was talking about a garage for your car. And I was young. I didn't understand the accent. So that still resonates with me. So the quicker you can get to financial independence is all about paying your basic bills with an asset that produces enough cash flow. To me, I only care about cash flow. I care about what's my cost to own the asset. I don't care really about the equity that I'm making. The equity is a byproduct of paying the debt down and having an asset that's appreciating. The only thing that matters to me is the net free cash flow. That's what we care about.
Right on. Okay, next question. If you could have dinner with someone dead or alive, who would it be?
My favorite band ever was Stone Temple Pilots. Scott Weiland was the lead singer of STP. Still is my favorite band. Love it. It would be Scott Weiland for sure. He was also from the greater Cleveland area where I'm from. And I would just love to know what was on his mind and why the hell he became an addict and died, because his music was phenomenal. So it'd be Scott Weiland for sure.
All right. Okay, Josh, if you weren't doing what you're doing today, what would you be doing now?
I'd be a volleyball coach, which I actually am a volleyball coach, but I would have loved if when I was younger, I played college football. I played 3 sports in high school, but I never played volleyball. I've got 2 girls. My daughters both play travel volleyball club. They travel all over the country. It's a super fun competitive sport. And I would love it to go back and be like a high school, college level volleyball coach.
That's awesome. All right. Book smarts or street smarts?
Definitely street smarts, but listen to a lot of books, right? I prefer to learn from someone than a book. And networking with really successful entrepreneurs is the best way to learn.
Awesome. Last question, Josh. If you had $1 million cash and you had to make one investment today, what would it be? No question. I would invest as a limited partner into a multifamily syndication, right? There's just no better way in the world to get a cash on cash return, a preferred return, call it 6, 8, 10%, whatever, 11, 12, 13 cash on cash, whatever that is. And then get equity on top of it. You just got to select a great operator, right? There's a lot of people who've bought multifamily properties in the last couple of years with floating rates, SOFR loans, that thought the market was just going to keep going up and it was going to bail them out. So I would make sure I would do an LP investment with a great operator with long-term fixed rate financing with very low loan to value in a growing market. That's exactly what I would do.
Amazing.
Oh,
awesome.
Josh, you're a superstar.
Really appreciate it, man. Just last thing here for our audio.
Yeah, please let everybody know what's the best way they can reach you.
My main website, all of our stuff is there. Our portfolio, passive investments, mastermind, YouTube videos, freelandventures.com/passive is the best place to get a hold of us.
Amazing, man. Really appreciate it. Thanks again. We got to get you back on to talk about your coaching program and discuss that on a different show, but we'll do that at another time. Thanks,
for
man.
being here, Josh.
So awesome. Thanks so much for having me on the show. I really appreciate the time.
Thank you for joining us for this episode. We hope this conversation enlightened you on how to win big in this highly profitable and risk-averse space. Get on your feet and embrace this world that offers so many opportunities just waiting for you out there. Continue your journey to becoming a savvy real estate expert by subscribing to the show at cpicapital.ca. Don't forget to leave a positive rating and share with your friends. See you on the next one.